Good morning, traders. Welcome back to another live stream. And when I say that today is probably the most important day of the rest of the year, honestly, I don't think it's an exaggeration, at least in terms of key economic data being released and central bank stuff. It doesn't get more critical than today. Okay, you have two things on the radar today that could massively move markets and change the dynamic of how we end this year. I'm talking we could be up substantially from here in terms of, stocks, cryptos, etc., or we could be down significantly from here based on what we get this morning and this evening. What I'm talking about specifically is US CPI, or a snapshot of inflation in the United States. This is pretty mission critical because we know without any question the jobs market is hurting. The jobs market has been slowing. It's been declining. There is serious worry out there about the state of the jobs market. What is the traditional central banker response to CPI? Jobs data being weak? Cut rates, right? That's the idea. Is you stimulate the economy by making borrowing low cost. That makes it so that consumers go out and spend more money. It makes it so businesses go out and spend more money. And what does that do? Well, that creates hiring. That's the idea, right? The idea is you make the environment easier to consumers and businesses to go out and do economic activity, which in turn boosts hiring in theory, right? But there's a problem. What if you can't cut interest rates because you have inflation rising dramatically too? That paints a very dire outlook if you can't cut rates because inflation is hot. Now, I'm not necessarily saying I think CPI will be hot. I don't know, right? We're here to react to the data together. But this is where I'm saying that if you get CPI cool, right? If you get a good, nice and friendly CPI print, the rate cuts are still on and the stock market may cheer. If you get an inflation print that is hot, the dollar will back up, head higher. The Fed will have to consider inflation risks more seriously, and it could dash the hopes for rate cuts. Okay? That is catalyst number one, and it is a big one. In fact, it's probably the most important one. We get that data, by the way, guys, in 12 minutes. So we have CPI, that is a huge one. Number two, less people may be aware of this, but it is pretty critical as well. It is the BOJ, Bank of Japan, later today is set to likely hike interest rates. The Bank of Japan is hiking interest rates. That part is not a surprise, right? They've signaled for quite some time that they want to continue to hike their interest rates. What matters today, guys, is from here, do we have a tepid, reserved Bank of Japan that says, all right, we're pretty much going to kind of stay there. We're not going to hike rates much further. Or do you get a scenario in which the Bank of Japan later today signals a rate hike and further rate hikes in 2026, meaning they want to keep going? Now, again, we kind of already expect them to hike a little bit further in Bank of Japan in 26. We are expecting them to get up to 1%. I think today they'll hit 0.75% interest rates. They are going to raise rates, but the big but is if you have the Bank of Japan come out swinging with a more hawkish expectation. Let me simplify that. If they basically signal more rate hikes than previously expected, it seriously could disrupt some of the major financial markets. Now, specifically, we already have seen the canary in the coal mine, Bitcoin, right? Bitcoin has been troubled by the recent Bank of Japan, rate hikes. If Bank of Japan signals further hikes in 2026, Bitcoin could continue its downward slope. If the Bank of Japan is modest, if it's like a dovish hike, right, which is possible if you get a hike, but then they kind of signal, all right, that's kind of where we're going to be. We're going to watch and wait. Then maybe Bitcoin has room to rise. So those are your two big ones. Those are your two huge catalysts for today. We also have, of course, unemployment claims coming out this morning as well, which will matter a lot to this market. Let's take a little look at market structure here before, what is the correlation between Bitcoin and Bank of Japan? Andrea, good question. To keep it really simple, the Bank of Japan historically offers low interest rates, okay? So what a lot of hedge funds do is they go to Japan, they borrow yen, they go out and they buy risk assets like crypto and stocks and bonds. They borrow money from Japan because they offer low interest rates. Think about if you wanted to go borrow money, who would you borrow money from? The lowest borrowing rate globally, Japan is very attractive for that. But if they're raising rates, that borrowing cost is no longer as attractive. And so what do people have to do? Well, if you borrowed a bunch of yen and you want to take off some of that risk, what do you have to do? You have to sell the things that you bought with your borrowed yen, aka selling crypto, selling stocks, etc., to go back and repay your debts. Make sense? Cool. Yeah. And it's important. What does the Edge Finder say? Let's take a look. Good question. Can I show you guys something exciting? I get so excited about this stuff because it takes us a long time. For the last 3 months, we're always busy with projects on Edge Finder, but check this out. In the last month or so, we've been working to get 3 new jobs market statistics added to our scoring matrix. And I am excited to announce that they have made their way to the stage. What you're looking at is the top setups algorithm, which looks at a bunch of data. It looks at technical readings, sentiment readings, economic growth readings, the consumer, inflation statistics, jobs market. It looks at a collection of statistics about the US economy. Jobs, of course, are a huge thing when it comes to determining the state of the economy, because if the average person is employed, that's good. If the average person is, losing their job, that's not so good, right? That's the point. So we get a snapshot of the state of the economy through this screening that we're doing right now. Well, we added more layers of intelligence, I should say, by adding the unemployment claims, the weekly jobless claims, which, by the way, we get in 7 minutes, some new data there. The ADP statistics, which are another kind of like the NFP, but it's private payrolls, very critical there as well, and the JOLTS job openings. So the algorithm continues to get smarter. The Edge Finder continues to build on its existing data set. And, each one of these, these things take us a lot of time to build and implement into our scoring algorithm. But once they're there, it's awesome because it adds a layer of intelligence to our system. So again, we kind of continuously add more to the top setups, although to be honest, we're running out of room here. But to be fair, I think we've captured all the big stuff, right? The main stuff. We've got a sentiment on economic output, the state of the consumer, inflation statistics, the jobs market, market sentiment, technical readings, institutional activity. We've got a pretty decent snapshot of what markets are looking at. So going into today, we remain bullish on gold, which I like that call. The NASDAQ has some good stuff going for it, but it also has some rough stuff. The jobs market data has been really rough. And if you lose the inflation story today, NASDAQ could very well flip from this peachy clean story to something a little lackluster. So watch this inflation number. It is actually very much potentially going to change the tone of the NASDAQ and the Edge Finder. If inflation comes in hot, it could disrupt the readings of some of the risk on stuff. S&P 500, with the recent flip downwards in price action here recently, NASDAQ and S&P 500 have gotten a little bit more cautious. What we can see here is that the momentum here that we previously had sort of lost its ground here. Once we lost that 6,800, we closed underneath here. Again, today's inflation report could send us, if we get a good inflation print, we could kind of recapture this, which I think would actually look positive. But if you see this thing come back up to the 6,800 level, be careful, because if you get a hot inflation print today, I would not be surprised whatsoever if we get a hot inflation print to see the S&P 500 make its way back down to like 66.75. We've really gone from clean uptrend to sideways, right? I wouldn't say this is a downtrend. I wouldn't say this is an uptrend. I think we've kind of flipped. I was holding on to this idea. Some of you guys may know I did get taken out for a profit on my NAS position, so I'm no longer in the trade there. I'm not opposed to getting back in if we get something constructive. You get something like this, right? That setup, all right. I may be looking to rejoin the trade, depending on what today's economic data release is looking like. We have a couple minutes to go, by the way. I'm watching the clock. But if you get poor inflation data, like hot inflation print, the NASDAQ too could head right back down towards that 24,200 level. I think you are fighting some seasonal forces, though, that come around the corner, which is that Santa Claus rally. We know that very well is typically a thing that we see end of December. It's not a guarantee. There never is a guarantee in markets, but you are talking about something worrisome in terms of Bank of Japan CPI. If we get past that and things look okay, Santa Claus rally makes a lot of sense to me. That's my thought. So we'll see what happens. I still have several long positions open, but I'm definitely a little bit more cash heavy today, which I feel okay being, right? If you get something where the market flush is lower, having a little cash on the sidelines for me sounds perfectly fine to be not fully exposed. I'm also watching the Russell. We tagged this 38.2% retracement level. I looked at it. I thought about taking a buy yesterday, but I decided against it because, again, I didn't want to take the jump right before CPI. I think with CPI, we could get some clarity. If we can break through these levels on a good CPI print, I may actually join the Russell trade. I like that quite a bit. So I'll watch it. I will watch that for sure. Why do we have correlation between the UK 100 and the pound? Yeah, let's look at the UK 100 really quick. So, so basically, yesterday we had really good inflation statistics for the pound. Pound dropped initially. It's back up here this morning, but that really, I think, what do we get? 3.2% inflation compared to 3.5% expected. I believe that is correct. I don't want to spend too much time on that just because I've got to move on. We're about to jump into CPI stuff, but yeah, that inflation print actually looks positive for UK 100, my personal opinion. US oil back down towards the lows. What I'm going to do now here, guys, is we've got just under 2 minutes. I'm going to switch over to our all markets view so that we can take a look at this market together. What you've got on your screen here is you have the US stock market, S&P 500, NASDAQ, US 30, that's the Dow Jones. Bitcoin is right here. The dollar's right here. Gold is right here. Silver's right here. Oil's right here. What you're obviously looking for today, guys, is if you want, dollar to be strong, you want inflation to be hot, because that would signal the Fed's not going to cut rates as much. That would be the idea. That would send gold lower. If you want gold higher, right, or if you want stocks higher, all three of these will probably, not certainly, but could move together depending on what the inflation print looks like. If you get an inflation print that is lower than expected, a cool inflation print probably sends the stock market up, right? Gold, same thing, more rate cuts, upwards for stocks and gold, downward for dollar. So I don't know what that number is going to be. I think it's a fool's game to try and trade right before the news spike. Be my guest if you want to, but please be careful. A lot of people lose a ton of money trying to gamble the news spike. The spreads alone will kill you, right? The brokers will widen the spreads because they want to protect their own capital, which is smart. That's what I would do if I was a broker too, so that people can't just throw $1 million trade on with 30 seconds to go. So please be careful. With that said, don't go anywhere after the spike. We're going to break it down and explain what we actually have. So we've got about 10 seconds to go. Let's see what CPI brings us here today. All right. Initially, dollar is moving lower here. Let me pull up my calendar here. Stocks are moving slightly higher. Gold slightly higher. Dollar lower. It's not a huge reaction so far. Let's see what the data brings us. Expecting 3.1%. Prior was at 3%. If we do get 3.1%, that puts us at the highest since the beginning of this year, I think. Which is kind of crazy. Oh, look at this, guys. Whoa. 2.7% inflation. That is much lower than expected. Like substantially lower than expected. Unemployment claims came in line with expectations. 224,000 compared to 224,000 expected. So nothing there. What about revisions? Any revisions? Did they revise that higher? No, not really by much, by 1,000 jobs. 2.7% inflation, 3.1% expected. That's a pretty substantial miss. I'm surprised the market isn't celebrating that more. Wow. What's up, Chris?
Good morning.
2.7% CPI. That is a huge drop. And yet markets seem not to be reacting too much to it.
Well, we did have multiple days of selling, and it's a little bit lighter volume. I'm not surprised to see the number lower though. We've had energy prices going down, you know, oil hitting some fresh lows, the shelter component, which is super lagging in the inflation data, and almost 40% of it has been coming down pretty decently the last couple of months. We just had the government shutdown, so it was difficult to get like the data the last 60 days or so. But yeah, that's a big improvement. I mean, I watched futures run from 0.1% to now 0.6%. So I mean, in the background, you're getting about a 0.5% move. So we'll have a pretty big gap at the open this morning to the upside. Yeah,
S&P 500 up 0.5%, Nasdaq up 0.85%, Russell's up 0.7%. So I guess there is a positive response here. You've just got such a, I guess it looks small compared to the flush that we had yesterday, but VIX down 4% response to this. Dollar index a little soft here this morning. Really interesting. I'm wondering if that supply or downside move in inflation, if anything, is there. Potentially off of, I'd have to look at the closer report, the broken down report, but is it goods and services actually dropping in price, perhaps due to low demand?
Yes, services has been deflationary a lot the last 30 days. So that could be a lot to do with it. I mean, look, let's take it as a win, honestly. If there's going to be a Santa rally, now's a pretty good time to do it on the coattails of, a couple. I mean, I listened to some interesting sessions last night. Just this is like a fragile market. Look, when we have, every little rip to the upside has been slowly grinding lower. There's not a lot of crazy protection during the holidays. It is a pretty vulnerable window. We're having a major OPEX expiration tomorrow. So, I mean, I guess the market's underbelly is a little fragile, but if we have today, today, let's say we do have that gap of 0.5, 0.6%. Let's say we get a follow through up to 1+%. Well, we reclaim a lot of the sliding that just happened the last couple of days. I think structurally that would put the market at ease, and we might even have a year-end rally, Nick. Maybe back to 6,900, maybe even back to all-time highs. So I don't know. I'm trying to be somewhat optimistic for the holidays, but I'm also hedged like crazy in case something gets worse.
Yeah, well, it's it's like you said, if it's going to happen, it's usually around this window, right? You only have like 6 or 7 trading days left, something like that.
Exactly.
For the rest of this year. So you've got, if it's going to happen, usually it's going to happen right around these times, last part of December. Really interesting to see. I mean, that inflation print is definitely promising for the Fed. In terms of cutting interest rates. Let's just take a quick look at yields. You can see 2-year yield moving lower off of that here initially. Here's your 1-hour chart. So 2-year yield suggesting, hey, Fed's got what it needs in terms of inflation. The check mark from inflation there for lower interest rates in 2026. And I think that you add that into the idea that the administration is going to put someone in there that is going to cut the rates in accordance with the Trump administration's desires. You've got a Fed that is, whether you like it or not, whether you agree with it or not, whether you think it will work or not, it's on the side of the stock market to cut interest rates, right? It's Now, the question would be, well, what if they're cutting interest rates really fast? Well, historically speaking, it is true that when the Fed cut interest rates really fast, it usually coincides with a big market drop off. But is this time different, Chris? Like, think about this with me. If you have a Fed that is like almost artificially cutting to appease the administration, couldn't that just send us into like absolute melt up on the stock market? Because it's not necessarily like due cause cutting interest rates, but because the administration wants it to happen. You know what I'm saying? Like, is that a different scenario?
Well, I think that what we're going to see in 2026 is like write these numbers down. The I keep talking about some of the wild and crazy tail risk that we've seen in 2025. We have more in 2026. There's a incredible amount of uncertainty. 5,500 SPX to the downside, 8,000 to the upside. Those are two very big like tails as far as like, could we go down at what's that percentage wise? If we go down to 5,500, that's going to be close to a 20% correction from all-time highs. 5,500 puts us around 20%, and then going back to 8,000 is probably just a fraction of that.
Chris, where are you getting that implied move? Say that again. Sorry, I think I missed.
So the Bank of America manager survey analysts, just kind of the big like bank analysts expectations. A lot of them are pretty standard of like, oh, they just go like 8 to 10%, project their highs and lows. But with this current environment, some of the AI uncertainty, blah blah blah, like the tails just got a little bit wider. 8,000 would be, okay, so we just went like 19% to the upside and 20% to the downside. There's your fat tails for the year. Good luck trading in 2026. I don't really take a lot from that other than, you and I have been saying cautiously bullish. It does make me want to sell a lot of premium for 2026 and give myself lots of room for error. And also have the dry powder, like we keep talking about this, have the dry powder to buy the dip. Back to your question. If we see a holiday rally into the end of the year, something tells me that this type of, okay, let's say we have a holiday rally and we do hit all-time highs. What do you see on this chart? I guess we could go sideways here and say this is a range. And if we break that range, is it possible that we go higher? Yes, but I don't think 2026 is going to be a flawless year. We have small caps with earnings expectations to be 59 times earnings, like the PE of 59 on the S&P and the Russell. Like 40% of the Russell doesn't make money. I don't know how that's possible. So I feel like we're going to fall short of all these like high, lofty earnings expectations. And it's like we had mentioned before, like any one event that just like kind of pushes the market over into like, oh no, earnings aren't as good as we thought. It's like it just starts tumbling down. What is hard right now is we've seen some big names selling, a lot of it in the AI space. Oracle is down way off those highs. In fact, it gave back that entire earnings move. We're down 40. That's crazy, dude. 48% on Oracle in the last 3 months. After everyone was like, oh, the AI trade, this is what it's like. That called the top. That was a 40% move, and it called the top, and it has been tanking almost 50% ever since. Let's see. AMD is down.
Broadcom down 22.5% in 6 days.
Like, and these are falling nice right now for me. Like, I do have a trade running on Broadcom, but it is all the way out to the end of the year of 2026, and it's also down below this It is COVID. No, the Liberation Day low at like 135. So I'm taking some time, but I'm giving this, as I've said many times these last like couple of months. It's like take the April low or the March low, take this rip up higher, draw a fib, and then see where things kind of settle in, because we need a cleanse. We need a deleveraging. We can't just have stocks run parabolic, which brings me to silver. Hasn't slowed down yet. Couple of stalls here, but still hitting all-time highs. I still think we're going to have it. You can quote me on this. It's like, I think we'll have at least a 25 to 30% correction on silver, if not more. So be careful.
What do you think triggers that sort of move, Chris?
That's the thing is, I don't know, dude. I don't know. Maybe the AI narrative softening a little bit, because I think what's bringing silver up like this is it's seen as the industrial side, the strategic side. We need this for national defense because we're winning the AI race, blah, blah, blah. Like maybe that's it. AI demand is there. The narrative is positive. But if that changes slightly, if this CapEx spending slows, I think silver tech growth, like I think that gets halted pretty quickly, pretty aggressively. But to me, silver still buy the dip. It's just expect the volatility. It's been a great run. Take some profits, trim your positions, and keep it as an allocation percentage. I wouldn't go heavy on it outside of, for me, it's like between gold and silver combo. I think I'm looking at maybe like 10 to 15% total, but not even close to. I'm maybe like a 2 to 3% allocation right now, just starting out. Like I'm going to build my position back up. I need some dips, man. I need some pullbacks.
Sure.
Yep.
Yeah, and I think it's practical. And the thing is, when it starts going into this melt up type mode, precious metals like this, what's worrisome is like, it's, in my view, it's either going to continue with this trajectory, and if it does flip, it's going to be trajectory like that to the downside. That's my personal opinion. I think that when you have these big rips, you have big dips. You have or big rips followed by big rips. So that's the difficulty with me for the precious metals is like, you want to pull back, but how much is, I guess, like the idea, depending on your time horizon. If you're talking about a big pullback, right? A kind of more of an investing level pullback, we could be looking at like 50, 45, 46 on silver, pretty quick. I mean, that could happen. And I would buy that, personally for the longer term, pretty happily. From a trader's perspective, I think that, when it comes to these dips, if you get anything beyond like the 38.2, 50% retracement, if that breaks, you're talking about maybe in the short run seeing a couple more months to the downside. I think that's something to worry about with precious metals, is that they are working like a Trojan warhorse right now.
Yeah.
But play that while it's there. But when that no longer is the theme, you got to shift, because they don't go up straight forever. And you can see that in the last few years, in a really solid bull market for precious metals, they don't pull back that much, right? This is the biggest pullback that we had, 15-16%, right? It's the biggest pullback we had in silver. And you can see that got bought aggressively. But if that had kept going, like, for example, if this kept going to the downside, I think you lose that, like, the invincibility.
Sure. Yeah, I don't disagree. I think that also, I mean, I'm dragging a fib from the low of April 2025 up to these recent highs, which I'll probably still have to make adjustments if we keep hitting all-time highs. But the 382 and 50, it's a long ways away, percentage-wise. If we get a let's say that this is like the top here, Nick. We pull back to the 382. We're looking at a 21% correction. We pull back to the 50. We're looking at about a 28% correction. Look, previous structure, I mean, all-time highs around 48. That could certainly be a healthy, like 27 to 30% correction, and also still be past resistance, which would be all-time highs in 2011, 1980, would offer support. Any of these moving averages, we are so far away from a 21 period moving average. We're so far away from a 50 period. We haven't hit I would have to check back here. Like I guess we did test it here back in August of this year, but just any type of dynamic support would be great. But to your point, I mean, maybe gold brings it down, in all honesty. I mean, I'm looking at gold as well. Gold, after it's kind of the same timing of this correction in gold, we have just been slowly grinding higher, right? And I will say one thing. Everyone that is super bullish on gold and everyone that's super bullish on silver, if you're cheering on gold and silver for the debasement trade or the fiat blow up, you're cheering for the wrong stuff. Like, there's no way that gold to the upside or silver to the upside is going to happen just because the financial markets or the fiat system is, we're printing more money. It's like everything's going to suck. If we have a big blow up side in the financial system, everything's going to be down. There is no safe haven. There isn't a safe haven. And it's if you have the dry powder and the understanding that you can scoop up stuff at major discounts. But I don't think there's any safe haven, dude. I think the reality is what I saw recently in the best kind of bear market is where do you hide out in a nasty bear market like we saw in 2022? You hide out in cash, or you hedge with currencies, or you have to hedge your portfolio. That's the only way to like hide out and actually limit losses or actually make some gains. But everything's down. So if you're cheering on like gold to the moon and silver to the moon, you're going to be surprised when like, wait, so we are blowing up the the Ponzi fiat system and blah, but it's going to be down with everything else before the dust settles and you pick up the scraps.
I was going to say, you can't hide out in bonds either. If you're talking about national debt
No.
blow up,
I would say literally just cash, like unallocated cash, right?
Yeah, because if you're sitting in bonds, right, like, and you have a national debt situation like flare up, gold would theoretically, right, continue to do well because it's outside of the US. But here's the thing, TLT, bond stuff, if you're allocated to bonds, here's the thing, is that if the national debt situation worsens, people are going to demand massive yield in order to lend money to a Ponzi scheme, right? If I'm just saying, like, theoretically, if that's the scenario, if people are like, oh, it's a Ponzi scheme, get out of the dollar, all that stuff, if that happens, the last people are going to want to park for safety is in the heart of the Ponzi scheme, right? So what would happen to yields? Well, they would go dramatically higher,
right?
Because people would demand, if you're going to lend money, you got to give me a really sweet deal. So, yeah, I mean, I would agree. I think if your gold is, I would say, the only place that makes sense for that specific area. That and cash makes sense to have dry powder. But even cash, I mean, if it's a dollar destruction scenario, then the dollar itself could lose a bunch of purchasing power. So maybe what you said about Forex too, right? Hedging across other currencies and things like that could be a smart way to play it as well.
It would be, whatever happens, it would be very, very ugly.
Not fun.
It would be unpleasant, if it lasts 6 months, a year, if it lasts 2 years, if it's truly the fourth turning. It's like all these things that would seem pretty dire. It's like the wealthiest people will come out of that as survivors and make a ton of money back up to, rebuild whatever positions were essentially lost. But anyway, let's go glass half full here. Mags gapping higher, Apple gapping higher, Amazon gapping higher, Broadcom gapping higher, Google gapping higher. I'd say, what's the market been waiting for? Tech has been down a decent amount. The rotation has been pretty clear with this like slow grind to the downside. But everything right now, Mag 7 wise, is getting a little bit of a pickup. And I think that pickup is encouraging to see that now we have the big boys coming back to the market. Maybe this is a bit of a year-end stability, year-end rally. This was kind of the final news piece to come in and kind of finish us off until we officially have like Christmas and Christmas into New Year's. That is the technical Santa rally, by the way. Everyone calls it seasonality from Thanksgiving onwards, but the technical Santa rally is like the 7-day window from Christmas Eve to New Year's Day. I wouldn't be surprised, Nick, if the market does make this kind of miraculous rally. Let's have a little lesson, a walkthrough back in 2024. When we did have an interesting, the December month did finish negative, but we had an attempt. This was our Fed December day, and then we rallied hard to revisit that, and we didn't sustain it. But this year we actually pushed up during the Fed, fell, kind of controlled these last a couple of days. I don't think it'd take a lot to get back into this area, make a run back to 6,900, maybe even get a holiday poke towards like the highs of the year. Interestingly enough, there is a JP Morgan collar trade pinned at 7,000, which to me, as far as like option flows and gamma, could be a level that the market wants to try to test. It's also not unreasonable. Right here, we're looking at maybe a run. So back to highs is about 3%. If we get to 7,000, we're talking a 4% rally, which that's a lot. I mean, not going to lie, it's a lot in like 2 weeks. But could it happen, or at least retesting the highs at 69? I think, it could happen. So we'll see, man. I mean, honestly, I think today's kind of a make or break. We have a good solid day where we have a gap up and push. That'll kind of, I don't know. I just think that's going to like put a lot of concerns at ease, where it's like, okay, we're not just sliding every single day where every rally is sold. If we end today where we have a gap higher, my charts are all messy, I know. I saw that in the comments on Tuesday, like, how's this guy see? It's like, look, I've been looking at charts for so long, like I don't even see these indicators unless I need to. So it's just been that long. Anyway, if we have a gap up today with some follow through, I think we end the year on a pretty good note, and we have that positive drift going to the holidays. If we gap up today, Nick, and we fade it, and we're right back down where we started, then honestly, man, it doesn't look great. We're coming back down to possibly the NVIDIA candle low, that October 10th, November 20th candle. And that's around 65.20. So either way, we're about to find out.
How much do you think about this these worries about some of the AI stuff, Chris, like the Oracle story. Do you think about that a lot? Like, I don't know. Do you think Oracle? Here's another one, a way of thinking it. Do you think Oracle's on sale right now, or do you think this is a worrisome chart?
Well, let me tell you where I think it's on sale. It's down 50%. If I'm going to touch this thing with a 10-foot pole, it's going to be with levels below 120. So we're at
120. Yeah.
Yeah, like there's no way that I'm testing. I mean, this is what a big lesson was for 2022. What's up and making all-time highs that's tech and overvalued could easily turn 50, 60, 70% to the downside.
Yes.
Don't catch that.
Like
Don't
Netflix.
guess. Don't guess when this thing.
Remember Netflix, Chris?
Yeah.
2022. Oh my gosh, that thing, like it was a darling. Bill Ackman, big fan of it, all that stuff.
Bill Ackman, what a terrible trade. I mean, that guy lost. I mean, all he had to do was buy freaking put. That guy lost like $1 billion on Netflix.
Yeah, and I think
unbelievable.
I can't remember exactly what happened, but I didn't he like buy the shares and then sell them. Unfortunately,
he sold them post earnings for like a 20 or 30% loss. Netflix was down 76% from peak to trough in 2022.
Yeah.
So was Meta. Meta was down 70%.
That was the stock, before it just goes to show you when it comes to stocks, when it comes to anything, gold and silver included. I know there's a lot of people in the room who are like, gold looks indestructible right now. Everything that you believe is impossible to happen in markets can happen in markets. That is why trading is so difficult. Gold looks invincible, silver looks invincible. Understand they can be down 40% next year. I'm not necessarily saying that's what I think is going to happen. I'm a trend follower. It frees me of having to make big predictions like that. I just follow what's happening. But here's the thing. I would never say never on anything. If you're somebody who's watching the NASDAQ, do you know that the NASDAQ dropped 80% in 2000 following the .com era or something of that nature? It's very close.
Yeah. Amazon was down over 90%, by the way.
Yeah. Like, look at this, guys. So again, the internet was literally like, people love to, with hindsight, say like, oh, well, the .com era was different because they didn't have any profits. Well, that's true. But they were valued not super unreasonably. And then all of a sudden they had this absolute melt up beyond. And then what really set off the valuations was actually earnings weren't keeping up, right? And then you had people still euphoric about it. And then sort of slowly realization came to like, okay, these companies don't make any money. 83%, the leader of the free world, the USA, the highest quality, innovative tech companies of the world, dropped 83%. Never say never. Please be careful in markets.
Yeah, man. And look, at the end of the day, there's no rational thing that the market has to do. I mean, I think if anything, what we have now in the modern markets is we do have a government that is using the stock market as a scorecard. We do have a Fed that is trying to provide stability and kind of navigate these really uncertain waters that we've had the last few years with inflation. Are we sticking to the inflation narrative? What about the labor market now? I mean, part of me thinks that, I mean, if we're smart government-wise, we start to retrench like training programs versus if AI is going to displace all these workers, the whole idea of nobody's going to work and we'll have universal basic income, that sounds like a terrible dystopian future to me. I would rather have people have, a purpose and have like just retrain people. Like let's build new industries. Let's do something where it's like you actually can have a job that pays well, and good things can come of this versus this is Armageddon. This is the worst case. It's like I've never been like extreme bull. I've never been extreme bear. I think at the end of the day, you just have to trade what you either see or trade what you look. If you're trading growth, you got to trade what you believe in. You got to trade the story a lot of times because price to earnings, price to sales, all those things are overvalued with the growth story. If you want to trade value, then you're looking for little to no price appreciation, but decent dividends and its protection, lower beta, non-correlated. You can also, hedge with volatility. I guess you can obviously, like I showed the risk-free trade. If you want to do like the box spread, it takes a lot of capital, but you can get like a solid 4.25%, 4.5%, in a broker platform. There's ways to do it, but I mean, I don't know. That's the thing, is like, we're talking about literally a 20% tail left or right. I don't know what's going to happen next year, but I would say that if I do see what I did this whole year, is if we see the VIX spiking up, I'm generally going to go to, all right, well, if I want to sell some premium, how far out do I go and how low can I go? And this year I use the April lows as a great spot to sell. I mean, we're now, if price is going to come back down to April lows, we have to see prices drop 30%. I'm pretty confident that wasn't going to happen this entire year as we were getting flare-ups in the VIX. So going into 2026, I'm still going to use April lows, because how awful would it be if we're like, struggling here, but we do make all-time highs, and yet we somehow have a VIX up to 40 or 50 sometime in 2026 for whatever reason. I'm going to sell premium and probably go out and not make a ton of money, but enough to make like, maybe a couple $100, maybe a couple $1,000. But using this April low, it's like, okay, the market has to do something outrageous to the downside. And again, as you just said, it can happen. Like nobody should ever trade definitively. If I ever see a prediction that's just like, this will happen, it's like, you have no idea and you have nothing to substantiate that claim. So you have to trade with like risk in mind. And there's always like, yeah, if I lose, I lose. But
because here's the thing, Chris, like I can paint, for example, if we could flip over to my screen for a second. If I want to paint a bullish perspective for 2026, which is kind of my base case, like we talk about cautious optimism, that phrase is so key because we always say it. The reason for that is because even if everything kind of aligns well, there's a good chance the market is pretty priced for it, right? It's pretty excited about that concept. Anyways, inflation here out of the US this morning was a really nice number. We actually, we double topped on 3% inflation, at least for now. That's a good sign, right? Let's just take it for what it is. That was good print. We expected 3.1% inflation. We have consistently for most of this year, guys, been under inflation expectations. We were worried about tariff inflation. It seems to at least not have shown up just yet in any sort of meaningful way, 2.7%. Now, that's a very good thing. We also can look across the pond. The UK just had excellent inflation compared to expectations. The reason I'm showing you this... Yeah, go ahead, Chris.
No, I'm just listening.
Oh, yeah. I thought you said something. But what I'm trying to get at with that is that, okay, inflation is cooling. That gives the central banks of the world a little bit more relief to keep interest rates at a lower level. Now, one of the biggest ones would be if inflation in Japan could actually come down a little bit, that would actually be nice, because then they wouldn't hike rates so much, which would be a tail end risk, I think, for 2026. But one thing I think the point is the Fed generally is in the direction of QE and cutting interest rates. We have an administration that wants to cut interest rates, that is very pro-business, whether you like the policies or not, or whether you think it will turn into a fair distribution of wealth or not. The point is, for the stock market's perspective, lower borrowing costs and an administration that will do everything to pump up the stock market is a major tailwind theme. Not to mention you have, earnings growth that is pretty remarkable for these US companies. Now, all of that said, there is no certainty in what I'm saying, right? That's what, Chris, you just pointed out. I agree wholeheartedly, and I hope everyone in the audience listened carefully to what Chris said right there. If you hear somebody who says the market will do this next, or the market is going to go up, or speaks in absolutes, in trading, that is a disaster waiting to happen, because I just outlined what I think is a generally bullish outlook for 2026, but I have no certainty. I am going to position for that, but I'm also going to plan for exactly what I'm going to do if I am completely off base and something comes out of left field. Bank of Japan starts hiking rates aggressively, or oil prices spike on something, Taiwan and China. Nobody knows. Nobody knows what the market's going to do with certainty next. Anybody who claims they know is an idiot. Like, at the end of the day,
they're not trading it. They're not trading it.
Yeah,
it's like traders should know better than to have those definitive terms. Here's what I'll wrap up with today. Themes for 2026. We talked about this in our big kind of forecasts. Like, I think the markets have lofty earnings expectations. That to me is where the left tail comes in, is if we don't, like, the US right now is pretty much priced to perfection. I know things can be hitting expectations, but I do know that elsewhere, like European markets, for a price to earnings at like 12, 13, they don't have to do anything other than just like, it looks okay in Europe, and things could be pretty solid. We're at like 24, 25 times earnings. We're in the 1 percentile of highest earnings. We're at the second highest all-time Cape-Shiller ratio. If we have any flinch in earnings growth, the market will let us know. Exactly. And that's where I think that the big risk is next year, is like, we just don't have this perfection that's going to be maintained. The labor market, it's still really slippery. You know, the jobs. I mean, even Jerome Powell said that we're probably underestimating the labor reduction. Like we're probably closer to like down 60,000 jobs a month versus 20. The housing market, it's straight up an affordability crisis. I know the Trump administration is trying to do things to bring the housing market back in line. Here's the deal: you can't really crush housing prices. You can catch up with supply, but right now it's like the yields have to come down. You know, if somehow this government Fed combo gets yields down to like, you know, I guess yields back to below 3%, 2.5%, 2%. If we get interest rates on homes, 30-year mortgages back down below 5%, 4.5%, I would be shocked if we do it. If we do it, fantastic. We'll drum up the refi volume, and first-time buyers will probably come back in. There could be crazy incentives to buy homes. Honestly, it probably just goes to the top end of the K anyway. But still, it's like if there's at least programs showing like, look, we're not trying to smash or ruin the housing market, but I don't want to see the government get back involved in housing. I mean, the one thing is they've been rolling out those mortgage-backed securities. I hope they do not get back in housing. And then bond yields, of course, this has been the sticky subject all year. Will we actually see, you know, sub 4% 10-year yields, or will we see global yields on the rise, which they have been all year? So even though the Fed has cut 1.75%, our yields are actually higher than when we started cutting in 2024. That's not a typical correlation. So these are my big four themes of like, okay, I do have some concerns in 2026, but it's a midterm year. I think that Trump, if the administration is not careful, they will lose the midterms in a disastrous fashion, I think. But it's not for like the right reasons. It's like you're just unhappy that like your state, your current situation is not great, so you're going to vote the opposite way and hope for more like, you know, hardcore socialist programs. It's like that's not the right solution. I mean, my God, it's just like politically we are a freaking mess. So anyway, back to trading. Earnings were price perfection. That does have me concerned. It's going to be tough to keep companies still just cranking out amazing earnings, but Mag 7 could still do it. I just wonder if it's the other companies like the Oracles Oracles, IBM's, Intel's. I mean, Intel's government backed right now. That doesn't mean it's foolproof. Oracle's down 50%. Does it continue to get worse? It's like, I'm really cautious on that front, but I would say what would be encouraging is, okay, man, tech has had its day in the sun. How about a rotation?
I agree.
How about that full rotation where it's like the broader market can actually show that, hey, we can make money too. We're actually benefiting from AI. Healthcare could benefit. I agree. I think a lot of ways to make things better.
If you want to see the market keep going, mature into, you know, fourth year, et cetera, I think that's where you got to go. Is you got to get some rotation and participation. Chris, we're out of time. We got our next show host, and I know you got to run too. So thanks as always for joining us on the show, guys. If you enjoyed Chris's commentary, make sure to go find him on his YouTube channel. And if you want to get access to the trade alerts being shared by myself and Chris, you can check them out on our website. Send us a direct message on our website by using the link we'll drop here in the chat. If you have any questions, speak to them. Let them know you want to get access to Chris Pulver's trade alerts or my Pulver alerts or my alerts. You can bundle the two, whatever you want to do.
Nick's Pulver alerts.
Nick's Pulver alerts. Yeah, if you want Nick's Pulver alerts, just send us a message here. Anyways, Chris, thanks for coming on, man. We'll see you on the next one.
See ya.
If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
Okay, what's up, people? I've shared my screen. That would be nice if I could do that. But yeah, I hope everyone is doing well. As always, we can run through a bunch of different markets. Any requests, I'm happy to go through, drop them in the chart, excuse me, and I'll be more than happy to go through. I'll go some pairs which I'm interested in. Also, we'll go through a bunch of USD pairs as well, We just had a bunch of news, pound, euro, dollar. We've still got yen potentially as well. So there's still a lot of movement potentially in the markets and opportunities that could follow that. Of course, we do have the festive period coming up pretty soon. So I do wonder about follow through on these moves. We might see some nice intent, but maybe we do take a break over Christmas and New Year's. But besides from that, we can go for some opportunities. I'll start with some USD pairs. Of course, always drop a chart if you are interested. What's up, trading it? Hope you're doing good. A1, it's good to be back on the stream. So hope everyone is well. So yeah, we'll start with the dollar. So USD, from a higher time frame perspective, is just a little bit. It's kind of like in the middle of a range. We've got equal highs, equal lows. Of course, we have been seeing a continued bearish move for the past maybe 2-3 weeks now. And there is still room to the downside. We can still very much push to 96.5, which is the lower end of the range. Now, typically, if I'm looking to trade this, I want to be closer to the extremes. So resistance or support, I want to be positioning myself at those highs. But of course, if you're intraday, it's difficult to do that because this is a daily range. You're not going to wait maybe 2-3 weeks for price to get back to the high or low. But what I can say is that structure is still pointing down. So as long as structure maintains, which is these lower highs, that means the overall force at play on this time frame on the 4-hour chart is still bearish, and that's the direction we're going to anticipate price to continue until proven otherwise. And if we are going to see a full swing to the low of the range, we could be looking at a push to 97, maybe 96.5. So there is still room to the downside. And taking that information into pound, euro, etc., which of course have just seen some significant news events, well, we're seeing definitely a bullish reaction here for pound USD. And dollar still being weak there has definitely allowed us to continue. But again, it's difficult to look to buy pound because we do have a lot of obstacles in our way. So I do worry about the strength, or maybe strength's not the right word, just the clarity of the path we have to trade in. It's always nice if price is coming from a high and there's not a lot of support resistance, so you can expect to see a smooth ride. Here we've got a lot of resistance to our left there, so despite us looking pretty bullish and momentum still pretty up, we're still seeing force to the upside. I do worry as we do approach some of those levels, 1.346, so if you're going to look for buys on pound, I would probably scale down to like a 15-minute chart, 15-30 minute chart, and look for pullbacks and shorter term moves, just because you can squeeze a bit more risk reward out the opportunity. If I'm trading this on the 4-hour chart, I've got resistance just above my head, so that's why I'm a bit reluctant to look for longs here for pound. Whereas if we can flip over, there is room back to lows, but we're not really seeing the chart show us that. And same thing for euro as well. Euro, of course, currently quite bullish right now, but still we do have a lot of resistance above our heads here, so I do worry about, again, how much upside we can see there as well, despite euro being fairly a little bit bullish, but USD still being pretty weak as well. So for the USD pairs, I would say predominantly bearish on the dollar is still very much the path we're seeing USD take. So especially if you're day trading, that's the direction I want to be in. But in terms of opportunity, I'll probably scale right down for decent risk reward, because there is a lot of noise in the higher time frames. And again, if you look at a lot of the USD pairs and you kind of zoom out a little bit, daily, weekly charts, a lot of these USD majors are just in ranges. Euro's in a range, pound USD's in a range as well, or at least coming back into one, as we can see. Dollar CHF is in a range here. You can see Aussie dollar's in a range here as well. New Zealand dollar, not really. This one's kind of trended down, trended up, but again, not really seeing much expansion at the moment. And of course, DXY is in a range. So we do have a lot of range on the USD pair. So not the optimal conditions, especially if you're trend trading. Still, there's opportunities, especially intraday, which we just mentioned, is just big swings. I don't think we're quite positioned well for that. What time is the JP policy rate? I think it's like 3 a.m. on Friday, UK time. I'm not sure what time that is Eastern. But yeah, I think 3 a.m. tomorrow, UK time. Could you take a look at gold? Of course, we can have a look at gold, no problemo. So gold still very bullish. Still the predominant force here is the buyers, still very much in control. Yes, we're seeing some red flags of maybe price slowing down, but no significant pressure to the downside to tell us that this is it. We still got highs, which price looks like it's eyeing up to go and take. Of course, silver, its partner in crime, has had a massive move to the upside, looking enormously bullish. Gold kind of lagging behind a little bit, so I think that's a little bit of an opportunity for gold to do some catching up. I'm not necessarily saying a massive breakout, but I do think the synchronicity between them two, both being bullish, I think is, again, adding more fuel to the fire. From a technical perspective, everything's pointing up, still seeing higher highs and higher lows, which is, again, the most important thing if we're going to be looking to buy. The market is still showing a lot of upside. I would say, though, if I'm looking for a trade, I do want the market to pull back, because effectively what's happening is, yes, we're bullish, but we're failing at highs, and we've done this essentially 3 times now. We've tested the high once, we came back again twice, we came back again a 3rd time, and we're still struggling. Of course, doesn't mean price can't break through, but do I want to buy gold at this price? No, because then I'm kind of just guessing price will break out. I'd rather price pulls back deeper away from that level to more significant value, more territory where I'd expect other buyers to be getting involved, and then potentially we can go have another move. And worst case scenario, the worst case scenario, you take a loss, but the second worst case scenario is that price could potentially rally, respect resistance, still give you an opportunity to profit from that move. And if it does roll back over, well, you can still walk away for a small win potentially, or at the very least a break even. So I like the zone we got trading below us here. Nice consolidation, and we broke out of that quite aggressively last week. So it would be a really nice opportunity if we could see price pull back into that zone, naturally have a pullback, reject this area well, and that could be an area where we see another higher low form, lines up pretty well with this trend line, and still keeps that bullish bias intact. And then we're still looking for price to go and take those highs. So yeah, gold really bullish, just struggling at highs at the moment, which could invoke potentially a bigger pullback. I would say the invalidation or the red flag would be if price was to break through this, especially aggressively. Again, that doesn't necessarily mean that gold is bearish now long term. It just means we're not as bullish as we thought it is. So maybe that could give us a bigger pullback. This could turn into a bigger range potentially. Of course, a million things could happen, but it just means that we weren't as bullish as we expected it to be or assumed it to be. So maintaining this area, I think, is quite significant. Let's see how price gets there and how it rejects. If it looks sufficient, I think that's a smart place for some entries, and where you can see price really push through. So I do think there's a lot more upside for gold, and of course silver, which I just touched upon as well. This one's absolutely crushing it right now. Absolutely crushing it. So I kind of want to see gold potentially catch up with silver, but maybe not to the same degree. But there's definitely upside as well. Okay, we'll take a look at pound USD as well. Rises to 1.35 only to fall potentially. Again, like I said, for the USD pairs, they are just very flat. So I don't really see, well, of course anything can happen, but I don't see price having much sustainability with this move unless something really kicks in, like we see some real force, some real buying pressure, because this is a lot of resistance. And if you look across the higher time frames, which again they're more significant, you're seeing from a monthly perspective bearish candles coming through. We're not really seeing the force we need to break through just yet. So as we do approach 1.35, as you mentioned, I do think anywhere in this zone here is an area which we could really struggle, and especially if this continues to look corrective, we could very well roll back over. Again, as a trader, it's so important to be reactive rather than be predictive. So you can identify that 1.35 zone as an area which we could reverse from, but then it's up to price to get there and then react accordingly. Because of course, like for whatever reason, we might pick up some strength and we could actually break through, which will of course change our bias or at least make us reanalyze things. So yes, absolutely, 1.35 is an area which we could turn back from. If you look at the prior high here on the daily chart, it was technically a lower high than this low. So despite the pullback we had, despite that momentum, we even failed to create new highs there. And then this high went and created a new low. So this is showing that the bullish trend from here is a lot weaker now. Again, I wouldn't necessarily it's categorically over, but there is definitely reason to expect some downside from here. But let's see how price gets there. At the moment, we are looking quite corrective intraday. So let's say if we can push up, maybe fail at highs again, roll back over, break through some key lows here. Yeah, that for me is a big sign to say this uptrend is probably exhausted, and we start expanding down, seeing a bigger ATR. Price is likely to continue fall here, and then you got a lot of lows to potentially pinpoint, or potentially the ultimate low down there. So yeah, I do agree with that, and we could see a similar price action for a lot of the USD pairs because they're a lot in that kind of consolidation zone as well. I quickly want to touch on some pairs I'm looking at. We can go through a couple yen pairs as well because we do have the rates tomorrow, so they're an interesting one. Aussie CHF is actually an interesting pair because I'm actually looking to trade Aussie CHF. I'm actually looking to see if I can find some selling opportunities for Aussie CHF. I quite like the price action here. It's like a market that has been ranging for a while, kind of trying to poke low, trying to poke higher, unsuccessful with pretty much every breakout. So you can see we had a low there, price poked through. We had a new low, price poked through as well. It pushed the upside with a high, price poked through there as well. And likewise there too. So we've just been poking in pretty much all directions, which I like because it means that it's very kind of direction is not quite clear on the higher time frames just yet. So what I'm looking for an opportunity is for price to return back towards resistance here. Then I'm looking to see if I can short it at least back to the low of the range, because this up move here potentially has stopped out some early sellers, maybe trap some early buyers there as well, and should allow us to take advantage of a push back to the low. Of course, I say should, but it's all probabilities. And of course, we do have the situation that we are quite bearish in the higher time frames. I'm pretty sure these are all-time lows. Yeah, I'm pretty sure. So Aussie CHF, categorically is very, very bearish market. So shorts look good for me. We're back within the range. So essentially, we're just looking for price to reconfirm that this is truly resistance. And then we're looking to see if we can short it to the other end, which is not going to be 0.516 roughly. So there's a decent tradable room opportunity there. You got some distance there, especially if you can drop to like a lower time frame. You can really maximize that in terms of risk to reward. So I would like to see a push higher, reject wicks, engulfing candles, something like that. Reject well, see if I can get some stops maybe above the high. And then you're probably looking at 1 to 2, 1 to 3 back into that zone. Of course, this is hypothetical. We'll see what actual entry we can achieve. Of course, it is important that we do hold that zone. If price does suddenly break through, that invalidates the whole opportunity. We're still seeing price expand at that point. So yeah, Aussie CHF, I actually quite like it. It's on the watch list, so I'm keeping a close eye. I'll go through some of the yen pairs. You like short Rico? I love the long Aussie CHF. The thing is, I've been looking at both kind of sides of the coin. That kind of position will take time and cost you so much in swap. Potentially, but if you look at prior moves, you've got this bearish move 1, 2, 3, 4, 5, 6, 7 days. So a week's worth of price action. Well, a bit more than a week because you get 5 days. So it took a week for us to get there. From this bearish move, it took a lot because we paused and came back up. But of course, that did it in one candle. And this probably did it in about maybe 7 or 8. 1, 2, 3, 4, 5, 6, 7, 8. So potentially I can estimate between maybe 7 to 10 daily candles to get there, which means, yes, I will have to hold through swap. But again, if I can extract, 3, 4, maybe even more R, depends on my entry, that would definitely cover the cost of the swap, 10 times over. So I absolutely understand the point in terms of swap and why it's probably more attractive to long from that regard. But again, when you're looking at swap and fees, you have to, percentage that against your edge. So if it does eat a lot into your edge, and of course it's not something you want to entertain. If it's still a small fraction and your edge still has a lot more profitability to it, then I just see it as a cost of doing business. Because if the market's going to go down, then I want to profit from it. Yes, I'm going to be paying for it too, but it just depends on the transaction. Is it worth the cost? If I deem it to be, and again, I'm not looking to hold for weeks on weeks potentially, but I understand the point. If we do break higher, if we do see price expand higher like this, then I actually would be bullish and looking to long, because price action is expanding that way. So if I do see price, maintain these higher lows, then I would be bullish and I look to long. And of course, I would have some positive swap there too. But I understand your point completely. Gold short or long. Again, when I do analysis, not necessarily to say short this, long this. I'm just explaining my outlook on the market, and you can do with that what you will. I'm sure you can find Chris's channel. You just search his name on YouTube. Makes sense. Prefer the long swap. I was done cutting rate risk on bet. Yeah, fundamentally it does make sense as well. I guess my kind of mentality is just opportunity. Does the opportunity outweigh the potential downside? So that's the risk of the trade, the fees. If that opportunity, at least to my sense, makes sense to do, then I'll still take that trade. And of course, if things do flip, I'll hopefully look to see if I can participate in some longs with you as well. One thing that I've learned in trading is you don't want to be stubborn with one bias. That definitely is a trader killer. I will take a look at some yen pairs quickly. Why don't you look in BC Press? I'm sure Trade Nick will cover that. I'm a very technical based trader, so I do stay aware of interest cycles, but I prefer to go into more detail in terms of the price and what the price is telling us. Because at the end of the day, fundamentals are great, but you do need that element of price to reaffirm that fundamental bias. For example, if you are bullish fundamentally but price is bearish, well, there's no opportunity. If you're bearish fundamentally and price is bearish, well, then you have opportunity. And fundamentals are good because it does act as a filter. But again, I'm aware of the fundamentals. I don't focus too much upon them. I'm aware of interest cycles and how they affect the market. And that's primarily where my focus is fundamentally. Other than that, I'm very much trying to pinpoint my opportunities with price and what price is behaving. In terms of the yen pairs, so again, we do have rates, funny enough, for yen tomorrow. Again, the yen interest rate's always a bit funny, but we presumably have them tomorrow. And we're expecting a rate hike. So if that was to fulfill, then naturally you expect some bullish momentum for the yen itself. So that could be some downside for the yen pairs potentially. Now, from a technical perspective, everything is still pointing up for the yen. So even with that rate hike on the horizon, would I start looking to short the yen? Absolutely not. There's nothing here that tells me I should be shorting the market. All I'm seeing is higher highs and higher lows. We can focus on pound yen here, but if you do want to see a particular yen pair, let me know. So you can see the market is still very bullish. We're still seeing higher highs and higher lows. We're still creating new highs, although this last leg did fail at a high there. So that is a bit of a warning sign. But again, doesn't necessarily translate to, okay, we're bearish now. What I will say with pound yen is that we are trading at some significant prices, and a lot of the yen pairs are doing that as well, which naturally means the market is getting ready for a bigger pullback at some point. Of course, when that happens, no one knows. It could be now with the interest rates coming up. It might be potentially mid 2026. Who knows? All I can see is read price. What is price doing? It's still bullish, still giving us higher highs and higher lows. So the opportunity for me still lies to the upside until I start to see some lows being taken out and price expanding lower with some real intent. Because even just a minor break of structure like a 4-hour chart isn't really that significant. Does a minor break of structure in the 4-hour chart tell you that this multi-year trend is over? No, it doesn't. You have to wait for some real evidence, especially from the higher time frames, to really tell you that this trend is over and price is actually trending down. So even if we do take out some of these lows, it's a sign that, okay, maybe we're pausing, maybe a bigger counter trend could form. But ultimately, I'm not really going to treat that as a complete reversal until I see some real intent on like a daily, weekly chart. And if I see price start to flip bullish again, well, we're back looking for longs, expecting the trend to continue. And that really much is the same outlook for all the yen pairs. So I wouldn't really look to try and find anything at the moment for the yen pairs, just because of the uncertainty coming up with the rates. Dollar yen still again predominantly bullish, so again naturally looking for buying opportunities. But again, I would wait for post rates to start sticking some positions, especially from a swing perspective, because things can change. But again, still pointing up. Swiss yen still pointing up, despite fading at highs at the moment. New Zealand yen, CAD yen, Aussie, Euro yen, you name it. We're still, whoa. Someone is spamming the chat. That is crazy. No problem, Max. Happy to help. Don't even know what that question means. Do you need to pause videos? Anyway, so yeah, that's kind of my take on the yen. Patience, wait for the rates, because especially with the rate decision potentially contradicting this trend. You know, if rates do go up, it does affect how bullish potentially this trend will be from a fundamental level. So therefore, maybe the trend could start to unravel. And of course, price will tell us that, you know, if people are going to stop investing, in these bullish trends, we will see price tell us that. Market will fail to create highs. We'll start to see some bearish pressure coming to the market, especially in the higher time frame level. I stress that with a lot of importance, because a lot of people will drop to like a 1 hour, even lower, and start to say that, okay, yeah, the market shifted, when absolutely that's not the case, or at least you can't say that with a lot of certainty. So yeah, a lot of yen pairs still pointing up. In terms of my watch list, I quite like dollar CAD to the downside. This is a pair which I've been looking at since maybe last week, since we got this bearish move here. Yeah, I think that was not last Friday, the Friday before. Really nice commanding move, breaking through structure here. This is really showing real intent, which is why I like the opportunity. We've seen real intent on the move down. So essentially, I'm looking for us to get a pullback and a continuation to the next key level. At the moment, the market looks like it's bouncing at support right now. And I'm looking to see if we can get a pullback anywhere within this area here, between 1.388 to 1.395. I'm looking for a pullback and then hopefully a swing back to the lows here. Again, a decent risk reward opportunity. That's really my focus when I'm looking for swing trades is, yes, there might be an opportunity in the market, but is it worth your capital? Is it worth your time? You want to make sure that the earning opportunity on that is worthwhile, especially for swing trading. I understand day trading, scalping is a different ball game. A lot of the time you want to be in and out of the market. But if you're looking to swing, it's to make sure that you're, excuse me, my voice is playing up, is to make sure that you're looking to achieve a lot more than you're risking. You know, you want to hold for that appreciation in that trend. So with dollar CAD, things are looking very bearish right now. I do see more downside. However, I would like to get that pullback, so that might need a bit of some bullish strength from USD, a bit of weakness from CAD, a mixture of both potentially. And then I'm liking the shorts for a push back to that low. Aussie CHF we spoke about, expansion of the range. We're back in it, looking for us to hold the high back to push the low. And then you got Euro Aussie, a very similar trade as well, which consistently trying to break the lows, not seeing any successful expansion as well. We're seeing failure to create new highs, but we're not expanding low, which is a big concept to understand. A lot of people look at price failing to create new highs as, okay, price is going to reverse, which is true to a degree, but it only makes sense if price actually sees the momentum to reverse, because otherwise it's just price taking a break and potentially looking to continue the trend, which is kind of what we have here. So with Aussie CHF coming back within key support, we've got key resistance above us there. All I'm betting for is Euro Aussie to retest and continue back to highs. And of course, we are aided with the higher time frame trend still being pretty bullish too. So we're taking the advantage of the natural kind of tailwind we have here. So, and again, Euro Aussie longs and Aussie CHF is very similar trades. So I won't take both. I'll just see which one gives me the better risk reward, better entry, etc. Like I said, dollar CAD, I like the shorts. Euro CAD, I like the longs as well for this one. I have to be a bit careful because we are very stretched and the trend potentially might be coming to a pause. We've taken out some monthly highs. I say monthly, this is back in 2017, yearly highs. So we have to be careful with the longs, but again, I'm not seeing price pull through. We're still holding areas where we've seen a lot of volume in the past. That for me still bodes bullish. So I am liking the longs here. And then the Aussie CAD, I don't really have a setup. I'm just kind of waiting for more information yet. Again, another market which is ranging. We kind of fake to go higher, fake to go lower. Haven't really shown our hands yet. I want to see what price does at this low. Does it completely break through? Does it quickly break through and recover? Does it respect it? That's kind of what I'm waiting for. And then maybe I can find a setup around that. But at the moment, there's nothing quite there. So yeah, a few pairs which I'm looking at. USD still looking predominantly quite weak. So USD majors look like they're still on the way up. But again, I won't be looking to swing them for the fences. I think day trading is the best outlook. But yeah, guys, we have approached the end of my segment. Thank you so much for having me on the stream. Really do appreciate that. I hope you have found it useful. If you have, go check out my channel. A lot more content similar to that on my channel there. So if you are liking it, go check it out. But yeah, guys, really appreciate it. Have a great one. I'll catch you all next week. Take care.
Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello everyone, welcome to my segment of the live stream. So I do hope everyone is doing well. The big news today, I can see the CPI print. So CPI for the US, 2.7. That's a pretty good number. So that's a pretty, well, I would say it's a pretty dovish number, because if the inflation was elevated, then the central bank cannot cut rates. So that's a big shocker, kind of. We can take a look at the CPI, core CPI or just the CPI. So yeah, 2.7. To be honest, I was expecting a hotter print. So I was expecting it to be at least 3% or maybe even higher than that. So the reaction from the markets, let's check it out, is DXY. Well, the DXY is lower, but not so much. Let me see the 1 hour. Yeah, the 1 hour definitely moved. So the 1 hour chart definitely had a bearish reaction on the DXY. As far as my watch list goes, I'm watching NZD USD. So I'm looking to enter a buy position. I didn't have a buy limit set. And I think during the night we hit the 20 MA. Yeah, basically 4 in the morning we hit the 20 EMA, but that's okay. So I'm looking to enter, maybe if we go back around the 20 MA, and I don't want to place just a buy limit. And so I was waiting for 2 things. I was first waiting for the CPI print, which came out now, or like, what is it, an hour ago. And then I'm waiting for the BOJ policy rate, because it could be pretty important depending on what the BOJ does. If you have been following my streams for this week, you would know that if BOJ hikes, it's a big implication for the markets. Just to quickly go over why it's important. So if we look at the USD JPY, and we open up the carry trade scanner on the edge finders. So if we go to, where's my carry trade scanner? Is it here? Just a second. So it should be under interest rates. No. Okay, I'm not sure what happened to the Edge Finder. Why is the carry trade scanner gone? If anyone has some news on that, you can let me know. You can let me know in the comment section. Anyways, back to the charts. So dollar has a positive interest rate or a higher interest rate than Japan. And the carry trade is basically when people buy the dollar, sell the yen, and they collect positive swaps. That's basically it. So they collect positive swaps from the interest rate differential. Now, the US is cutting rates and is going to cut rates in 2026, while Japan is possibly raising rates. So if the US is cutting and Japan is raising rates, that differential keeps getting smaller and smaller. So the swap amount keeps getting smaller and smaller. The swap income gets smaller. So that could cause the carry trade to unwind, and it could cause the dollar to lose value against the yen and overall possibly in the markets. So last time that happened, the carry trade unwinding happened on the 11th of July 2024, and it was a big move lower. So that was the carry trade unwind when the BOJ started to raise interest rates. So that's the second thing I'm watching on the US dollar in order to gain a better bias, in order to have a stronger bias. If they keep it the same, then it's pretty much game on for, well, it's not game on, but I'm going to be more certain. They can actually hike as well. I mean, it doesn't really matter too much what they do if they keep the rate the same or hike. I just want to see what happens throughout the event, and then maybe I can get an even more bearish bias on the US dollar. So that's what I'm waiting for. So let's see. Hello, Melissa. Hello, Sluggy. Gold. Alan says towards the bottom. So hello, Alan. Let me see. Did I miss it? Stock surprise, market heat map. Indices, gold and silver commodities, Forex scanner. Interest rate data. No, I don't see it. Here it is. So FX macro scanners. Looks like they have changed things around a little bit. So it's now in the FX macro scanners, carry trade scanner. So this is what I meant. USD JPY. Base currency rate, quote rate, divergence. This thing is going down. This thing is going up. The divergence is getting smaller and smaller. So the carry trade is going to produce less and less income. That's a problem. That could cause USD JPY to go lower. For the dollar to lose value, yen to gain value. I'm waiting for the event. You can also see that it's tentative. It's going to happen, but they don't announce the exact time. So the Bank of Japan is the only central bank that doesn't announce the exact time when the interest rate will be published. But if you look back at their last couple of meetings, usually they do it around 10 p.m. New York time. So this could be the same scenario. So around 10 p.m. New York time, watch out for the numbers, and then you will see what happens. Some of the other stuff we had yesterday was the GDP CPI, which came in cooler than expected. Then NZD GDP, which came in better than expected. So that's good to see. Yeah, that is definitely good to see. NZD reacting off of that, not really, but I still like it. So I still like the New Zealand dollar. Again, the GDP seems okay, seems healthy. The RBNZ Central Bank of New Zealand has flipped from being dovish to being hawkish, which is great for the appreciation of the New Zealand dollar. And I'm looking to buy it. Currently, my favorite currency pair is the NZUSD. Reading on gold. Yeah, we can take a look at that. Top setups. Gold. Bullish score of 8. That is pretty good. Some of the other stuff that we had the Bank of England official bank rate. They cut rates. The vote was, well, definitely a bit different than the forecast, or a bit different than actually the same as the forecast. Sorry. Yeah, the same as the forecast. The movement, I didn't even check the GBP. It's not on my radar right now. But let's take a look. 1 hour. Well, a bullish reaction. So looks like the pound has interpreted that, or investors have interpreted that as being bullish. And then we also had the main refinancing rate for the European Central Bank. They kept rates the same. I'm going to do some research, look into it. If possibly they are more hawkish. Let me just see ECB interest rate. Euro area interest rate. Yeah, they have just been holding for a while now. So they have been on a path to just hold rates. And we're getting the ECB press conference. But to be honest, the most important number today was the CPI. Everyone was looking at inflation, and I thought it was going to be hotter than expected. So I thought it was going to be above 3%, if I'm being honest. 2.7 is a pretty good number. Pretty healthy number. I'm not sure if this is a bit of old data because we had the US government blackout, but still a healthy number. So that's great. That's very bearish for the dollar. Good for rate cuts. Let me see how the rate cuts are priced in. FedWatch tool. So let us take a look. By December, has anything shifted? No, it's pretty much the same. Around 29% for 300 to 325 basis point target range. So that is interesting. That is about it. Again, the next big news is going to happen around 10 p.m. New York time today. BOJ, I'm going to be closely watching it. If there's anything super important, I will make a post in the A1 Trading Discord. So if you want to join the A1 Trading Discord, you can get a pretty nice discount with my code, not Marmo, but Marco. In the Discord, you get trade signals, trade analysis, trade breakdowns, a chat with other successful traders, and it's signals from Nick, Iwind, Chris Pulver, and me. It's not just a signal. It's also a full explanation of why we take a specific trade. So if you want to learn to trade, I think that is the best way to go, because you can just mirror what we are doing and learn through applying these trades or through executing these positions. So check it out. Gold was next on the table. So we kind of went through the Forex Factory calendar. Let's check out what gold has been doing. On the daily, silver pulling back a little bit. Gold, I'm actually, so I did some reading, and silver this year is up. Let's take a look. How much percentage has silver made this year? So from January up until now, it's 121%. And if you do some backtesting, you would notice that when silver makes more than 100% per year in returns, usually the year after that is break even or negative. So because in 2025, in this year, silver made 120%, next year it is very, very likely that we will have a negative or break even year for silver. And silver has kind of gone parabolic, just a massive explosion higher, massive speculation inside of this uptrend. So actually, I think I'm going to focus my attention onto gold in the upcoming year. Gold is up, still a pretty hefty amount, but it's not 100%. So gold is up around 63%. That is still massive. But I think the gold uptrend is not as explosive, not as crazy as silver. So I'm bullish on both, if I'm being honest. Rate cuts are coming. Inflation is still elevated. It's still above 2% in the United States. Trump's big, beautiful bill means a huge amount of spending. US government right now is in massive spending mode. Inflation will definitely go up and possibly even increase. As inflation goes up, gold and silver just go up. Edgefinder is currently bullish on both of them, so gold is getting a bullish reading. Silver is bullish as well. So I'm actually looking to get in, but because of that research that I did, I'm going to focus on gold. I want to get in around the 20 MA. If we can pull back to the 20 MA just before the breakout, possibly, maybe we can produce some sort of a cup and handle pattern like silver did recently. See, perfect cup and handle pattern. Not that I trade patterns, but it's just the way the market consolidates before a breakout. So summary is I'm bullish on both. I prefer gold at this moment because of the research that I read. And I want to get in, but I want to pull back. If we can pull back to the 20 MA or maybe even this support level, I will be looking to execute a position. So let's put an alert. And let's try to get in. Inflation is definitely a huge driver of the gold uptrend and silver uptrend. And then you have the Edgefinder as an extra confluence. So that's awesome. Okay, let's see. What else do we have? What's the new reading? So we went through the reading. Hi, Marco. With CPI at 2.7%, thoughts on the DXY to 95? So I still don't think that DXY hits 95. I think it's too ambitious. Look at the amount that we need to cross to go to 95. I would say it's pretty big. And yes, there was a massive crash, as I mentioned, at the beginning of 2025, but there was also a massive reason for the crash. Trump, tariffs, crazy announcements, crazy tweets, new economic regime. You need a massive catalyst to push the DXY so much lower. You're going to get 2 more rate cuts at the best in 2026 as the current situation goes. So in 2026, 1 rate cut I think is going to happen. 2 rate cuts is a bit, let's say, it's not that likely to happen, and 3 rate cuts probably will not happen. So rate cuts I don't think rate cuts will be the reason for the dump. I think the DXY could go down a bit, but not by a lot. You need a massive catalyst for people, the big whales, to start selling the dollar. You also have to think about it. The whales are selling the dollar and they're paying the interest. It's an expensive proposition. It's an expensive position to have, because as long as you keep holding a short on the US dollar, you're essentially paying 3.5% on that amount. So you're losing 3.5% every single year. Investors don't like that position. It's not a great position to have, especially the big hedge funds, pension funds, investment funds, banks, blah, blah, blah. So unless we get a crazy new catalyst for a bearish dollar, I don't think there's a lot more downside. I would like to buy, let's say, NZUSD because I think it's a good play. I think there could be a little bit more selling pressure on the dollar and a lot more buying pressure on the New Zealand dollar, for example. Okay. Is the bank cutting rates good for gold? Yes, it is, because it creates inflation. Usually, if you have elevated inflation, CPI, and we do have elevated inflation in the United States and pretty much in most places. So if you go to New Zealand, elevated, Japan, elevated, UK, massively elevated, Europe, okay, Swiss, definitely good inflation or very low inflation. Low inflation is not good, by the way. 2% is the sweet spot. Below that, the country is not growing. CAD is okay. Aussie is elevated by a lot, 3.8%. That is pretty bad. So if you cut rates inflation is high, you're just going to stimulate more inflation, or you're just going to cause more inflation. If inflation goes up, gold and silver go up as well. So it's definitely a bullish scenario. Definitely a bullish scenario for gold and silver. Now, a cold inflation print that we had today is probably not so bullish in and of itself, because on paper, inflation is not growing right now. So that's why you possibly have a bit of a red day on gold. We can take a look. If we go to the Edge Finder top setups, we find gold. Let's see. Click this, and then you get a more thorough reading. So let me show you that. See, this is it. And you have the CPI. No, actually, they count that as being bullish for gold, or Nick counts it as being bullish. So I got a bit mixed up, looks like it. Yeah, so it's a bullish confluence to buy gold, or for gold to go up. So I do want to take this time to mention the sponsor of today's video, which is DNA Funded. If you guys are looking to increase your trading capital, get more capital, because that is one of the main issues that new traders have. They can possibly make 10 to 15%, but making 10 to 15% on 5K or 10K, it's not going to do a lot of damage, or it's not going to benefit you much in monetary terms. So if you are looking to expand your trading capital, we have a 25% discount. A1 Live is the code. 25% off any DNA funded challenge. Okay, any challenge is 25% cheaper. This is my personal two-phase funded account. 50K, currently in minus 6.17%. Unfortunately, and I do have 2 trades open. Buy on the SPX, sell on GJ. They are kind of negating each other, so I'm still in drawdown. But again, I'm just going to keep executing, and we will see what will happen. So yeah, highly recommended. Great prop firm, ran by professionals. It's similar to FTMO, 5%ers, E8 markets. But what is cool about DNA, first, they're using Trade Locker for trade execution, which is awesome. Second, you get a much more competitive price with our code. So with this 25% off code, you get a great price. And you get a good prop firm. Check it out. Let's continue. Euro statement said no more rate cuts anytime soon. Let's take a look. What was the EU reaction off of that? Definitely a bullish reaction. So we have to wait for the press conference as well. Press conferences are pretty important when it comes to central bank decisions. But the statement is important as well. So let's check out, and hello, Robohola. Welcome to the stream. So let's check out the press conference, then maybe we can make some conclusions. Marco, this might be dumb, but isn't the cool CPI kind of bad because of the higher employment? Employment usually leads to lower prices. So essentially, I'm not exactly sure what you mean. Do you mean higher unemployment? Because we got a higher unemployment rate right here. See? Higher unemployment. But you're saying employment in the comments, so I'm a bit confused. What I can tell you is if inflation is above 2%, that's not good. 2% is the target. Above 2%, you have some issues. So if it goes back to 2%, that's great, that's healthy. 2.7 is still too high, still too much. So I would say if it keeps coming lower to 2%, and if it stays at 2%, that's the best possible scenario. Because elevated inflation, everyone can feel it. Everyone living in the States and outside of the United States can feel this elevated inflation in their daily lives. And 3% is not such a low inflation mark. Yeah, I know it used to be a lot higher. I know it used to be like 6-7%, 6-7. But also watch the South Park episode on that. But it used to be like 7.7%. 7.1%, which is extremely high. And that's really bad. So I would say it's not an issue if it's coming lower, as long as it stays around 2%. Okay. I'm hearing that CPI only uses gas and auto. Do you mean the automobile industry? Another thing that is good for looking at inflation is, of course, energy, oil prices, and oil prices are just steadily coming lower. So oil prices are intertwined with pretty much everything, because everything needs to be transported, and transport is directly correlated. The cost of transport is directly correlated with prices of oil. So as long as oil prices keep low, inflation will stay under control, I would say. It is one of the biggest factors in inflation. Oh, so you meant unemployment. Okay. So, Marco, this might be dumb, but isn't the cool CPI kind of bad because of the higher unemployment? Unemployment usually leads to lower prices, right? Well, there's a lot of market mechanics, but you can kind of say that. But I would also say that inflation needs to come down at the end of the day. That's just my personal opinion, but I think it needs to come down to 2%. And then the Fed can cut rates, and then the Fed can stimulate the job market. Maybe they can bring unemployment back to 4%. And also 4.6% is not that bad. We used to have a lot higher unemployment. But it's a good question. So if you go back 4 years, we used to have in 21, 6.1, 6.4, extremely high unemployment. This is still an okay unemployment rate. It's still not a major concern. It is rising. I'm going to have to admit that. It is rising, but it's still sort of in a controlled territory. Let's go back 8 years. And the median was kind of 4.2, 4.3 to 4.6, 4.7. And then, of course, COVID happened. But this is still okay. It's not that bad. One thing to note, AI may be causing the unemployment rate to go up because it keeps replacing the low end of the workforce. But again, AI has still not been fully implemented, so I don't think that's the case. Typical US session, dumping without any reason. GJ, sure, we can take a look at GJ. Top setups on the Edge Finder. I can show you that. So top setups. I'm going to filter for very bullish and very bearish. The only very bullish reading is the NASDAQ. There's no very bearish readings. So that's kind of it. And this is the top setups page if you're interested. So I'm just going to leave it on. Euro dollar. What does this mean to JPY pairs? Hi, Nick. Nick was before me. So Nick was the one who started the stream. And now you have me. And you have Miko, I think, before me. So it's usually Nick, and then you have the guests. So it's Nick, then it's James or Chris Pulver or Miko or me. By the way, you can look at the whole schedule right there. A1 live stream schedule, okay? So then you can see exactly who is on. All these YouTubers show only wins if they're not live streaming and just recording for uploads. Well done. Hope it works for you. Love how you're transparent with your PNL. Well, thank you if that is for me or if it's for Nick, because Nick shows his monthly PNLs. I don't do that. I have a MyFX book. So if you want to check out my track record, you can find it on my YouTube channel. Just type in Marco's Trading Journey, MyFX book, and it should be in the videos. The link should be in the video. USD 6.7 reported for 6.7. Gold has a 10 on your Edge Finder. No, gold has an 8. So yeah, gold has a score of 8 NZD/USD. CPI headline is cooked. Look at PDF, no data. Not sure what you mean about with that. So I saw GJ and I saw euro dollar. So let's do euro dollar. Euro dollar just had the interest rate decision, as I mentioned. Press conference is or has started, hasn't it? Yeah, I think it ended already. Yeah, sorry about that. So the press conference has ended. I'm going to have to look into that, do some research on the topic. But looks like it was a bit hawkish because I can see the initial bullish reaction. No follow through though. Follow through would be if EU kept creeping higher. Euro dollar is not my favorite thing to trade right now. Not my favorite currency. It looks flat on the daily chart, looks a bit range bound, corrective. So I prefer NZD/USD or USD JPY once we get the BOJ. So after BOJ passes, I'm going to consider taking a trade or doing something with the JPY pairs. Until the BOJ decision, I'm not even looking at any Japanese yen pair. Just a side note. So GBP JPY, I'm not even looking at it until the BOJ passes in the next, I would say, 12 hours, something like that. Although it is in a pretty big uptrend, if they hike rates on this meeting, yen should gain value. Yen should definitely gain value, and it could ruin the uptrend. We need to get the numbers. We just need to get the numbers. I think it's too uncertain. I think going into this event with a position open is a bit dangerous. BOJ is very unpredictable. So from my research, from following some other successful traders, most of them are flat on the yen going into this event. So I'm going to follow that. I'm going to be flat on the yen as well. But you can catch me tomorrow on the stream and you can get my take on the whole situation, because by that point, I should have all of the information about the BOJ interest rate decision. So Marco, thoughts on what's next for JPY pairs? Just waiting the BOJ. Just waiting for this event. Will they hike rates? If they do, if they don't, how will the markets react? And then we can structure some positions. So that is about it. Thank you guys very much for watching. As I told you, you can catch me tomorrow. Here is the schedule, A1 live stream schedule. So tomorrow I'll be streaming at 9:30 Eastern Standard Time, and I'll know a lot more about the BOJ. Thank you. Good luck. Don't take any massive positions on the yen right now. See you tomorrow.
Thank you for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want to get put on the nice list this year? Then make sure you check out the A1 Stock Box. That's all for today, everyone. We'll see you tomorrow. Ho, 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 ho.